Hello friends, Astrologer Mohnish here, and thank you for watching my videos on Vedic astrology and financial astrology. Now, this is a members only video. Members who are using my VIP indicator, they might have already seen that this is a game changer. You might have already experienced that how easy or good trading can become if you're using the right tools. And our VIP indicator, based on artificial intelligence, is that tool. It is very, very accurate, above 95% accurate. And if you include my astrology predictions with that, you can reach even higher rate of success. Now, I'll talk certain things about today's market, and also we'll talk about how to protect your portfolio and how to see that something is about to come, something is about to shake the market. And again, using my VIP indicator, you can protect yourself. And how? You have to just watch this video till the end, understanding what are the signs of that the market is about to shake, market is about to retrace, market is about to lose its strength, and what are the indicators which tells us instantly that the huge drop is coming soon. A fast shaking drop can come instantly. So watch this video till the end and then understand the whole strategy. This will make you a master trader if you watch the whole video. By the end of this video, maybe watch again till you understand the concept. But if you understand this thing, you will become a master trader. This is one of the best strategies and the tools what the top hedge fund managers uses. Nobody talks about them, nobody tells this, but I'm telling you from my experience and expertise, being your guru and being the astrologer who is committed to bring good things in your life. I'm sharing this with you. So slowly and gradually watch it, absorb it, and understand how the whole thing is being played out. So stay tuned. So before I start, I want to talk a little bit about the Bitcoins. You see, it's a daily chart of BTC, and today is 29th of October 2024. And you see the big jump here, right? Our indicator even showed it's going to be bullish at this point when it was 62. And now it has hit 73K. Now, this bullish run is primarily because the market thinks that the Donald Trump is coming back into the power, and he's a very strong supporter of Bitcoins. And second is Microsoft announced that they are going to invest in BTC in cryptocurrencies. So this is more emotional rally. My astrological forecast is still that the healthy range of Bitcoins should be somewhere between 68 till 58. This is a healthy range. And if you can see easily, after hitting 73K in 1 hour chart, the Bitcoin has started to retrace a bit. It is finding its support here, maybe second support here, and then let's see what it goes. It goes up or down, but I certainly believe, based on the planetary position also, which I shared in my last video or my last post on YouTube, that it should be retracing back. It's more like an emotional rally. If we bring a volume profile here, we can see that where the volume is. So visible range volume profile, we use this indicator, and then if we create a visible range of volume profile, you see that in 1 hour chart, volume is pretty much drying up. Volume is right here at 71K. And if you go with the daily chart, you can see our signal is still says take profit, profit hit happened. If you played 1 hour game, 5 minutes game, you would be have made a lot of money and a lot of success using our indicators. But here you see that even this, the whole, look at this bar, high volume, high volume, volume is drying up here. Another way you can see this is there's another indicator called fixed range volume profile. And then when you select this, all you need to do is you see from this wave, hit the cursor here until this wave. Okay. Then you can see where the volume is. And you see here the volume, there's none volume. So nothing is trading here. This is more like an emotional rally. The big guys are trading at this price point. 63, 64, 66, 67. Nobody is, these are all small scale retail guys who are just pushing the market up, sentimentally, emotionally, but there's no volume there. Again, volume profile is a very good indicator. You can use it along with our indicator. It always gives you very good annotation or good signal and sign where the market is and where the people are buying and selling, where the majority of buying and selling is happening. Okay, so this is how you You can see it. I'm sharing that one of the techniques with you. So volume profile, if you need volume profile, this you have to sign up for the premium plan on TradingView. It's not free plan. But again, if you don't want it, you can still use our indicator and run on it, because our indicator baked in the volume also, where the volume is, where the trends are, where the momentum is. And you can see pretty much when the price is at here, this indicator was showing that it's time to retrace and rebound in daily chart. And in 1 hour chart, you can see our oscillator is already showing there's no volume here. You are getting into a trap. So be aware of this. So again, what volume shows, our indicator also shows it, but I'm still sharing one more technique with you. So let's talking about how you see what is about to come in the market within 5 minutes. So again, I'm going to start with a blank canvas. This is NVIDIA stock, but we don't need it. I've removed all the indicators so that there's no confusion. You need to open an indicator called VIX. Okay. So if you don't know how to do that, you go under symbol search and say VIX. VIX is a volatility measure index of US stock exchanges. So here I see I'm clicking on the volatility index symbol VIX, and here this symbol is VIX. Okay. So you need to understand this, that VIX means volatility. Where is the volatility? How big is the volatility? And how much the price can move in a particular day or particular time frame. Volatility. How much up and how much down can happen. Okay. So you can see that on the daily time frame. So measure this every day, 5 minutes. Come on the daily chart and see where volatility is. And you see today is pretty much very low, 18.6. So that means stock market is not moving that much. Anything below 18, below 15 is very, very low volatility. Above 15, we can start saying that market is moving a bit. But when the volatility goes above 20, you see that? That means the market is moving very up and down highly. Okay. Now, the higher the volatility, the more the price movement is happening in the stock markets. The lower the volatility, the more calm breeze, more calm oceans are going on. So nothing majorly happening in the markets. But now you need to understand the relationship between volatility and the stock exchange, stock prices. So what I'm going to do is I'm going to bring another indicator, just a comparison. So click on the plus sign comparison, and I'm going to click S&P 500 and new pane. Now you can see in here, the below chart is S&P 500 and above is VIX, volatility. And you will see that VIX, the volatility indicator, and the stock movement, which is here, they are inverse to each other. They are inverse to each other. That means whenever volatility goes up, the stock prices will go down. Here you see that? This gigantic up and this is down. Okay, this is going low and this is going up. So whenever volatility is getting lower, stock prices will go higher. Okay, whenever the volatility is going up, right in here, the stock will go down. And you can see that again and again and again, multiple times going backwards. You see that? You see this volatility up on the 14th of September, the index was 13, and from 13 it reached till 21. And here, the same day, the stock price S&P 500 from 4467 dropped almost to 4034. So almost 10% drop happened. Whenever the VIX goes up, you see in here going up, and here it's going down. Whenever VIX goes down, it's going up. Look at it. So if you draw the lines here, it is going down. The volatility is getting back to normal. 18 is, we say, normal. Okay. 18, 15, we say the market is hardly moving. We don't trade. 15 is like nothing is happening. 18 is, yes, something is happening. We can make money in the stock trading on 1 hour chart, 4 hour chart, something is moving. But 15 below, nothing is moving. That's a sideways trend. But you see here, it dropped and the market goes up. This is the first thing you need to learn, that VIX is inverse of markets. Okay, I'm trying to write here. Sorry, pardon my writing. I'm using my mouse to write, which is not actually meant for this, but you understand the concept. Okay, now how you use it. Now, if you see what is about to come, you can be prepared. So if you go and bring our indicators here, our VIP indicator and our gamma indicator. Now you see in the daily chart, I'm going to reset it. You see, my indicator predicted here the bull shine. This happened on 15th of July. Okay. Our indicator mentioned on 15 that something is moving. This is going up. That means the volatility in the market is going up. Okay. This is what our indicator suggested. Now, here is where the point is when you get ready. You know it, the volatility is going up. How much it will go up, we don't know yet. Okay. Again, my astrology predictions comes into the picture that who is a planet who's expecting where the volatility would be. You can read it. But again, if you're not even using my forecast and predictions, this indicator is telling you everything. If you get ready here, just see 1, 2, 3, 4, 5, 6, 7, they boom. Huge volatility up spike and huge down spike in the markets. If you actually open this chart in a regular view, you will see how much market dropped here, right from here. See that? Even if you bring that chart of NASDAQ or any of the stock exchange, you will see that they all dropped. Dropped how many percent? They dropped from 5619 till 5079. So almost 10% dropped here. And this went up from $12. Again, you can trade this index also. You buy this index at 12 and you can sell it at 36. Whatever losses you have in here, you can make it as a profit. Or you don't have to have any loss here because ultimately you can trade on VIX index using the options, which I'll show you now. And you make money here. And then when the stock movement comes back to the normal, you are selling your VIX and then letting your stock come back to the normal position. And here you make double money because first you make money with the VIX going up, and second, you are making money with your stocks coming back to normal. Okay, so again, little advanced concept, but you will understand what I'm trying to say. So let's go a little more back. Okay, let's see here. It's saying the volatility is going up, and you see volatility went till 16. Okay, and you see that here, the price of the markets drop in here. So not big move compared to this one. But if you go back here, you see that huge spike here. Okay. Huge spike here. Okay. Huge spike here. Huge spike here. So 9 out of 10 times you will find the right signal showing you huge spike in the volatility and market is going down. You see that here? It going up, volatility going up, markets going down. Okay. Volatility coming down, markets going up. It's all inverse. It's opposite of each other. Okay. Go further down. You see that? And our indicator is telling you what is actually happening in the market days before the volatility goes very, very high, out of control. Here you see that from 26, it went to 36 and the markets dropped. Okay. So this is first you need to understand the inverse relationship between the volatility and the stock price index. Let's bring other index here. We're going to bring, compare maybe QQQ, that is NASDAQ, or we can just bring NASDAQ here and SDX, NDX. And you can see in here, let's do it again. I need to set the scale. So NASDAQ, NDX, and then we're going to pick the new pane so that they are not overriding each other. And you see that here, up. This is up, volatility is up, and prices are down. Price volatility is down, prices are up. So this is an inverse relationship. Now, how you play this, it's very simple. Okay, I'm going to explain that to you. First of all, use our indicator to know where the volatility is getting up, or you can set up the alerts. All you need to do is you click on this chart, say set alert, and then say when VIX value reaches above 20 every time, or whenever our VIP indicator is saying bullish, open long, bullish sign once per bar, and you say that VIX alert. Now, if you're using this TradingView app on your mobile phone, you say create. Whenever the green sign comes here, you will get an alert. On your mobile phone also, on your Apple phone or your mobile phone or your watch also, if you have synchronized your Apple Watch. So now you prepared when this is happening. Now let's say you this day, particular day, you see this green sign, okay? And you buy some VIX options, and I'll show you how to buy those VIX options. Okay, you buy 2 contracts, 3 contracts, 4 contracts. You buy an insurance. Okay, you're buying an insurance when you buy a options contract. Okay, you're buying an insurance for that much many days when you see the volatility is going up. Okay, so when the volatility will go up, your options price will be very, very expensive, and you can sell them and make money. And I'll show you how. And you don't have to sell any of your stocks which are going down, because the stocks are going down, your prices are going up of your VIX index. You're buying this stock of VIX index, and then you are letting it grow. And when you see that the volatility in this line, the second indicator showing that volatility is starting dropping down, you sell it and you make money here. Okay. And then you let your portfolio come up on the normal. This is how you play the game. Now, let's assume that you enter here, but the volatility never hit higher. Okay. Because this indicator will tell you 4 or 5 days before that something is shaking. The earthquake is about to come. Okay. Something is shaking, volcanoes coming. But it may not happen also, right? I mean, one out of, let's say, 10 or 20 times that the volatility did not spike that much as we wanted. Okay. Like here it didn't go very high. Here it went high. Here it went very high, very high, very high. But few times it did. Nothing to lose. If you have a 2 option contract you bought in here, just as an insurance, you are paying only, let's say, $20 a day, $15 a day to keep that options. If this does not spike up and you see a red arrow here again, that the volatility is going up, but it didn't go crazily high, you sell that options. All you will lose is that 2 or 3 days of holding that options premium as a time decay value. And I'll show you how it is. Okay, so that means you're buying an insurance for that certain 1 week time. Okay, 1 week time insurance, and paying like $20, $15 a day. And if the volatility go upside, which normally happens 9 out of 10 times, your stocks are going down, but your options will make money for you. So ultimately, the goal is not to keep the VIX stocks or options for longer. You just only play for certain days when the sign green is happening here. When your alert says VIX is high or getting higher, close to 20, you are ready. You know that in next 4 or 5 days, something majorly can happen. Okay, let's say today, if I have to run this, and you can replay this. You can always go back and replay the whole strategy what I'm teaching you here multiple times to test it out. Launch a replay bar and see how it works. Very easy setup here. So let's say today VIX is 19. I won't do anything. I'm just waiting. If VIX hits 20, I put an alert and the indicator shows green here. I will go and buy some VIX options, and I'll show you how, and then how you trade those options. And you will see one more thing, that VIX goes much, much higher than the stock goes down. That means if you're losing only 10% in your stocks, you are making close to 30% or 40% in VIX. How come? Because you see here, VIX was $12 stock, $12 for one index stock, and it reached till 36. It went 200 times above, 200 times above. So if you're holding, let's say, 100 stocks of VIX from $1,200, it went till $3,600, right? Because $1,200 you invested and 200 times more of that. Okay, $2,400 you made profit on this. And this one, if you are holding, let's say, 100 stocks of S&P or NASDAQ, you lost only 10%, right? And that 10% is still recoverable, because ultimately when the VIX drops down, the markets will come up. If market does not come back down, is still dropping, the VIX will go higher, 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 and higher and higher. It will continue to go up, 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 up to make sure that to offset the losses what you're making here with the profits you're making here. Okay, so you need to understand this concept. Now, how you buy these options, I'm gonna show you that too. So stay. So this is Interactive Brokerage, the platform which I use to trade my options. So all you need to do is go to new window and pick the options trader. And when you click on this, you will see the same screen right in here, what you see on my screen. This is option trader, okay? So again, it's very easy to use. You can watch some of the videos. how to use interactive broker. Every brokerage have a different look and feel, but ultimately they're doing the same thing. Okay, they're telling you where the option contracts are, what are the strike prices. You want to buy the calls, or you want to buy the puts, or you can sell the calls or sell the puts. So again, this is the VIX indicator. As you see today, it's 19, and I use a lot of the technical indicators just to see the spot. Since on interactive brokerage, we don't have our VIP indicator. So these 3 lines, 4 lines tell us it's based on Fibonacci series that where the support and resistance is. So ultimately today is 19 here, the VIX is, and if we see and assume that this is going to shoot up, okay, based on our parameters, which we have already discussed, that the sign of green arrow is coming here on our VIP indicator, and we are getting ready that this may jump up. That means the stock prices will go down. So we want to hedge our positions. So how we are hedging it? We're going to go to VIX index here, find the instrument. And once you click on there, you see that if I move it to Apple, all these options are for Apple right now. Okay. And implied volatility is telling us in January it will be 23%, 24%. The options prices are basically based on the implied volatility. I won't go into the Greek side now, but it's very easy. You can learn it. Now, VIX index, we are going to do is hedging our portfolio. We know that the market is shaking, prices can drop. How can we avoid this and make sure that we don't lose anything? So what I'm going to do is I'm going to open, these are the months of all the option contracts, and we're going to go somewhere in 49 days ahead. Definitely we are paying more premium, but then we are getting insurance for those many days. However, we are not going to keep these options for that long. We will just sell them after 5 or 7 days. If market does not move up, we are quitting the position. If the market move up and slowly coming down, we will take our profits and move out of this option trades. So let's say we take December 17 because it's implied volatility 91%. So the more IV is, the more expensive the options are. So we normally generally buy when the IV is less. Here, IV is implied volatility is 91%. So we'll find something very cheap. We won't find something very expensive compared to 100 and 204 option contracts. So here we open it. And if you see, we'll find something a delta of 80 plus. Now, delta means how much your option price will move up with $1 move in the stock price. So if we pick this delta of 83, that means whenever the stock moves from 1937 to 2037, $1 move, $1 move in this particular stock, our option will become 83 cents more expensive. And this is what we want, that the more expensive our options are, the more profits we will take as the volatility is going up and our stocks are going down. Now you can do the hedging of the complete delta. Again, that's the technical stuff, that how much stocks you have. We give you 100,000 worth of portfolio, 50,000. Then you need to know how many contracts you need to buy here. But for this example, let's say we buy 2 contracts that is equal to 200 VIX index. So what we're going to do is we're going to go and say buy this price of this option at strike price 1450. That means it's in the money. $19 is where the price right now. We're going for the delta of 83, and we click on the buy. This is sell and this is buy, and you see here the buy comes in it. Okay, so we will buy this option at $415. Okay, so let's say this price. Now the market is closed, so it's not a live price what we see, but let's say $415. We are buying for how many days? 49 days. So if we do the 2 contracts, that means we want 2 contracts. So right click and then see the margin and the performance profile. That what will happen. Okay, so right click in here and see this, and here you will see even the instrument is saying that the maximum loss we can have is 830, and that will only if we let the options go till the date of expiration, and we don't want it. Okay, we are just buying in quick and moving it out. So now need to understand this thing. You see, today this is the break even. Our break even is 1868. If the price of the VIX goes above 868, you see the line here, we are getting into the profits. You see that? So if the price hits 20, we will be making $300 profit. But as we know, the price can go up to 36.40, and that means infinite returns. You see that infinite? So maximum returns can be infinite as the price going up, up, up. we'll make the money. Okay. And if the price goes down and you let the whole game play till the expiration date, which is in our case is 17th of December, then all you lose is $830. That's the max you will lose. So that means you're buying an insurance for how many days? So we are buying it for December 27, which is how many days apart? Let's see that, which is 49 days. So if you're buying two options for 830, that means 200 stocks of VIX, and you divide it with 49 days, you are actually paying $16 a day of insurance premium. So $16 a day you are paying to hold this till 49 days, till December of 17. $16 a day. And what our goal is, one, two, three, four, five. Let's say we have the same movement here, what we had in here. Just assuming, okay, the past movement doesn't mean the future will also be there. But what we are doing is we are just buying it here somewhere. One, two, three, four, five, six. We are holding only for 6 days. So for 6 days, if the market moves up instantly, the price of our options, which are paying only 415, for one option will go up till 700. And that is where the profit comes in. We will sell this contract after 6 days when the market is coming down to the normal. Always look at the right click here, the performance profile, that if in case you lose something at the end of this option trading, that means the expiration date, worst case scenario, you will lose only 830. That means you're paying the complete premium for those many days. We are not going to do that. Okay. And if the price moves up, let's say in 5 days, price moves, let's say if we can just play here the 5 days game. Let's say I'm going to bring the profit profile back to, let's say today is October 29. Let's say November 6. Okay. Let's see November 6. It's not showing us. Okay. Normally, if you're buying some other stock, you can change the profit payroll profile based on the date. But what I'm telling you is, and trying to teach you is, let's say from $18 today and November 6, the price moves to 36, we will have a jump of almost this particular option will hit $1,000 approximately. And if you have two contracts, you made $2,000 within 6 days. Okay. And then your underlying stocks, which is going down, they may not go down that much. They may be just 10% down, 12% down. Okay. And then if you have more stocks, then you can buy more options. Okay. More options like 3 contracts, 4 contracts. This is how you can do the calculation, how many you need to hedge it. But ultimately, if your stock's going down, this will go up. And after 6 days, all you need to do is you need to go to your orders where your portfolio, this option are showing, and you will right click them and say sell them. So you're buying these options for 415, and when they hit 1000 or 800 or 900, you just go and close that trade, and your trader platform will show you everything how to close it. It's very easy, very simple, and your stocks will come back to normal. Okay, because if the volatility comes down, the stocks will go up. So you're not losing anything in this scenario. This is called a hedging technique. You can do the same thing with buying the put options. I'll teach you in my maybe next video. But this is what I wanted to show you, that how the VIX indicator tells you what is about to come, how to get ready. And let's say nothing happens. Let's say after you bought the VIX contracts option, in 6 days, nothing happened. All you lose is 16, which is 2 option contracts. 1 day of premium, you're paying $16, multiply by 6, you end up losing only $96. That's it. It's an insurance money. What's wrong with that? But you are hedged your whole portfolio for something bigger can happen. My dear friends, this is Astrologer Mohnish. I'm trying my best to give you the knowledge, the strategy, and my VIP indicators. I want you to make money. I want you to be successful. And all you're giving me is a 1 cup of a tea. Now you ask me how many teas I take. I take as many teas as much you're giving me, as many you're giving me with your love, blessing, affections. Okay, so just give me 1 tea, 1 coffee a day, and be successful. Thanks for watching. I shall see you in my next video.